Assalamu alaikum friends, welcome to AFM 14 days revision crash course for September to June 2023, and we are on day 11, just 4 days left to finish our revision for AFM, and this is about interest rate risk. This is the last revision on your risk management because after this we'll be moving on to accusation. One advice that before you start with the day 11, please go through day 10 because that went through exchange rate risk management, foreign exchange. Okay, and most of the things that I've covered there are applicable to this day as well for the interest rate risk management because more or less you can say like forward option, they are similar with just a slight difference when it comes to interest. There in the foreign exchange, you have been dealing with two currencies. Here it is just one, which is interest rate. But let me tell you, this is based on the examiner's report also and also the marks that students obtained. That interest rate risk management, often students go bad compared to foreign exchange. So this shows that one needs to practice more on interest rate risk management. Okay, because both are easy. If you ask me which one is easier or which one is more likely to come, I cannot tell you anything on it. Okay, you might get both in one sitting, or sometimes you just get foreign exchange, or sometimes it is just interest rate risk management. Most of the time it has been seen that it is either of the two. Either it is interest rate only or foreign exchange, but sometimes it has been seen, which is not very frequent, that both comes in one question. Okay, mostly risk management, whether interest or foreign exchange, comes as a 25 marks question. So this should make your work a little easier because questions are very direct. Okay, it is a very standard questions. You just have to convert. If it is a foreign exchange, convert using the rates, find which is the lowest payment and accept it, or the highest receipt, give advantages, disadvantages, and or maybe one theory. Okay, maybe one theory question on treasury risk management or something like that. So this is the pattern of the risk management. Okay, that's why I always say in your AFM syllabus, if you tell me to pick up one area, one topic, which I would recommend students to do first or easiest is risk management. Doesn't matter whether it is interest or foreign exchange. Questions, the reason is questions are standard. You can predict the type of questions you are going to get. The only thing is numbers are changed. That's it. That's it. Everything else remains the same. The way forwards are given, the way options are given, the way futures are given, the way swaps are given. It's the same. You can just check the pattern if you want from your past paper. Okay, so let's start with interest rate risk management. More or less, it is the same what we went through foreign exchange. The derivatives are same. So first we are going to go through past exam history. I'm going to talk a little slowly because most of the comments that I've received, which I have to admit it that I often talk fast. Okay, I speak fast, so students are not able to understand properly. So I will go a little slow. Okay, I was going fast, assuming that I'm going slow, but when it actually students started commenting me, it is that I speak fast. Okay, so I'll be going slow here. Okay, so interest rate risk. Then we are going to start with the derivative, forward rate agreement. Whereas in your foreign exchange, it was just known as forward. Here it is FRA. Either they will say forward rate agreement or the short form, the FRA. You should understand that it's for interest rate forward. Okay, interest rate future. See, they will give you the name foreign exchange future, interest rate. They will give you whether it's for interest rate or foreign exchange. See, you will understand. If it is for foreign exchange, obviously they will talk about currencies. Emphasis will be on the currencies. They will give you the two currencies. If it is interest rate, they will give you the interest rate without mentioning currencies. Okay, this is how you figure it out. Interest rate future, interest rate option, interest rate swap, same thing. In foreign exchange also we have. Now, let us go to the past exam history and you can see it comes most of the time as question 2 and question 3. Mostly question 2 and question 1, I think it came in December 2019. FRA has been asked. In that same paper option is also a future is also asked. In that same paper option is also asked. And same paper only You have to discuss which technique, hedging technique is the best. This shows that you will get them together really. Okay, it's not possible that you will be only asked one. No, option, forward, and swap. Even option, future, forward, and swap. This four has a very high frequency of coming in your exam. And if it's interest rate, then learn the interest rate swap also. Yeah, that also has a chance of coming, and it is often considered as a challenging topic for students. The swap part and also the column. Collar doesn't come very frequently, but when it comes, students often struggle in the collar part. So that also you have to go through it well while you're studying. Then comes your internal hedging method. Does not come all the time, comes rarely, but when it comes, remember the order. First, internal hedging method has to be looked. After that, external hedging method. What are external hedging method? All the ones that has been described above. Option, futures, forward, swap, collar, these are external. Internal are what? For example, you have a payment and a receipt. You have a payment, you have a receipt, but they are the same currency. So tell me, are you going to deal with two different payments? Are you going to hedge one payment separately and one receipt separately if it's in same currency? No, right? You are going to net them off against each other, only the net payment or a net receipt, right? So that netting off or matching with each other or leading and lagging payment, if you know what I mean, leading and lagging, all these are internal hedging method. First you do this, then comes to external. Okay, so let's start with our interest rate risk. What does it mean? Interest rate risk means the risk that occurs due to changes in interest rate. See, when we invest or when we take a loan, it's a risk. We do not know whether interest rate tomorrow will go up or down. It can go up or it can go down. If it's a borrowing, interest rate going up is a risk for you. And if it's an investment, deposit, where you are earning interest, you do not want interest rate to go down. So in both ways, it's a risk. And you need to hedge this risk, like foreign exchange risk, dealing with currencies. Here the main thing is interest rate, there it was currency. Please understand this. Because interest rate is one, technically this should have been easier for students, right? Rather than dealing with two separate currencies, dealing with one thing, isn't it easier? But still, let me tell you, students find exchange rate easier than interest rate. Reason? Reason? Because they focus more on that. They keep practicing 1,000 times on that question. They ignore the interest rate part. Assuming it's the same, we just focus on one, the other thing will automatically know no. Even if it's same, you have to practice the questions on both exchange as well as interest rate. Please don't repeat that mistake. Whereas if you are weak in either of the one, you have to focus on the weaker part where you are weak. If your strong part is in your currency, you have to focus on interest rate because that's where you are weak. Don't focus too much on your. See, if you are good in exchange rate, foreign exchange, don't focus too much on that. Focus on the interest rate. If you are good in interest rate, focus on the currency. Don't focus too much on interest. That's how it should work. Now, let us go through this hedging tools. I've already discussed forward, future, option, swap. Swaptions is another one which does not have a calculation to it, only theory, a small part. And for further reading, please do not ignore the further readings. Whenever I say further reading, you have to actually go and do an active part. You have to go and read it. Where? On your ACCA website. Just log into your ACCA website. This is AFM. Go to the technical material, right? Technical article and read it. Which one? The name of the title is How to Answer an Interest Rate Risk Management Question. This one article is enough for you to score the marks. Because it's not possible for me to include everything on this lecture, on this revision series. Why? It will make the video too long. The reason for me to introduce this revision is to keep it small, up to 30 minutes. So that every day 30 minutes you can do a full revision of AFM where you cover everything. But it's not possible to cover each and everything in detail. Only the important things I'm covering. So wherever I say go and do this, go and read, go and find out, you have to do it. It's your job. Okay, I've done my part. Now starting with FRA. Okay, just a definition. You don't have to write this definition, just know what it means. That's why I've included it here. Okay, this is for interest rate. How forward works in currency? We have a fixed rate, right? We have a fixed rate, isn't it? Here also it is fixed, but for interest rate. The rate is fixed. Whether it's a loan, whether it's a deposit. There we have payment and receipt. Here it is about taking a loan or depositing. Okay, it's fixed. Interest rate is fixed. You need to understand two things. What is it? A buyer of an FRA agrees to pay a fixed rate of interest. Okay. In return, the buyer will receive interest on the notional loan or deposit at a benchmark rate of interest, that is LIBOR, as the start of the national loan deposit period. What does it mean? What does it mean? See, when you are going for an FRA as a buyer, okay, what do you have to do? You have to pay at that rate. It's a fixed rate of interest. You have to pay your loan or deposit at that rate, FRA rate. Okay, and in return, what will you receive? The interest on the notional loan or deposit at the benchmark rate of interest. What is benchmark? LIBOR. They will give you all these rates. If you are not understanding what this means, wait till you do a calculation. You have to go through the calculations and understand this part. Second, the seller. Seller, they sell at the LIBOR rate and they receive at FRA rate. You sell at the LIBOR rate and you what? You pay interest, or you pay interest at LIBOR rate as a seller. And you get FRA from the bank. For a buyer, okay, you pay at FRA rate and you receive at LIBOR rate. This only through calculations you will understand. I've explained you while I was doing questions. On my lecture is there, AFM lecture is there. You have to go through my AFM lecture to understand this part. Now, what is a benchmark? Benchmark is like, it's a variable rate, or you can say it's a reference rate, anything. And it keeps changing, okay? And when FRA reaches its settlement, buyer and seller must settle the contract. Same like forward in currency. Now, this is very important. If the fixed rate, FRA rate, is higher than that LIBOR, FRA makes a cash payment to the seller. The buyer of the FRA makes a cash payment to the seller. If the fixed rate is higher than the reference rate, okay, you have to make a cash payment to the seller. See, understand, whether you're buying, understand this one logic. I know you're confused. If whether you are a buyer or seller, fixed rate is what? FRA rate. It has to come to the FRA rate. Okay, so if you are paying less than the FRA rate, you have to pay extra so that you come up to that FRA rate. If you are paying more than the FRA rate, you are receiving something so that the rate comes to FRA rate again. No matter you are going up or down, it will come to FRA rate only. The only thing is you have to understand, are you receiving from the bank or you are paying to the bank? That's the only difference you need to understand. Otherwise, FRA rate only. Deposit, FRA rate. Loan, FRA rate. More or less does not matter. It is at it will fall down or up to the FRA rate only. If you understood this, you will understand everything. Okay, so if your LIBOR rate that is higher than FRA rate, what should you do? What should you do? Here they are saying fixed rate is higher than the LIBOR rate, FRA rate. You pay at the LIBOR first. Opening, you start with the LIBOR, right? But what is your fixed rate? LIBOR rate. So you have to pay extra now. You have to pay more because FRA rate is higher, no? You have to come to that FRA rate. You already paid LIBOR, the extra balance you have to pay. Let's say, for example, FRA is 5%. Reference rate, that is LIBOR, is 7%. You are paying at 5%. Sorry, it's the other way around. FRA is higher. Sorry. FRA is 7%. LIBOR is 5%. So you are paying at 5%, that is LIBOR. You are paying additional 2% also to the bank. 2% extra you have to pay because FRA is 7%. You understanding? So that's why they say you make a cash payment to the seller or bank or anything. Let's just keep it seller. So buyer of the FRA makes a cash payment. You are paying extra now. If it's the other way around, we know you are going to receive it, which is here. If fixed rate is lower than the LIBOR rate, you are still paying at the LIBOR rate. But because you are paying more than the FRA rate, now you are going to receive it. You are going to receive it from the seller. You are going to receive it from the seller means seller is paying to you. It's the same thing. Check from the point of the buyer always. Then things are very easy. Don't go to buyer, seller. Always imagine yourself as a buyer. So you as a buyer, are you going to receive or are you going to pay? That's it. If FRA is more than LIBOR, you pay. If FRA is less than LIBOR, you receive. You understanding? Check this with number. You will understand this better. Further reading again, ACCA article, technical article on your ACCA website, which is the title is FRA and interest rate swap. Please, it covers FRA in detail. Please go and read it. Now we are moving to interest rate future. Same like exchange rate, it is standardized. Okay, and here same thing. You hedge borrowing or deposit. Here the minimum price movement is 1 basis point. 1 basis point means 0.01%. Okay, and because this is interest rate now, understand the difference. This is interest rate. So interest rate future prices are stated as 100 minus expected market reference rate. Let's say they are giving you 7%. 7% is not your future price. Future price has to be 100 minus that 7%. That is 0.93 or 93. Sorry, not 0.93, 93, 93.00. Or let's say reference rate is 2%. So 100 minus 2, 98%. I mean 98.00. That's what is your price for future. If you're writing in terms of interest rate, it will be 5%, 6%, 10% like that. Okay, so that interest rate has to be deducted from minus. That's how you quote future, interest rate future. Understand this. Now, the difference which I was mentioning comes here. Everything else is same. But when it's an interest rate future, the way you calculate the number of contract differs. How? This one. There also you have to calculate number of contract and exchange rate also. Here also you have to calculate. The method is different. What is that method? No need to convert, no exchange rate, but what? The fraction. So first, it is always loan deposit or loan borrowing. Okay, whatever, loan or deposit, whatever, divide by contract size. This was similar there also in exchange rate also. Let's say 20 million is your amount that you have to hedge. Your contract size is 2 million. So 20 divided by 2. 20 million divided by 2 million. Multiply that fraction. What is that fraction? This only comes from interest rate future, by the way. You will not get it in exchange rate, okay? That is loan or deposit period in months divided by 3 months. Why 3 months? By the way, this 3 months is fixed. Don't change it. It's always 3 months. The denominator. Why? There's a reason behind this. I'm giving you some time. Think and tell me. The hint is it's there in the word. Interest rate future and 3 months. Okay. So because you know future are standardized, right? They're always for 3 months, isn't it? We have March, we have June future, March future, June future, September future, December future. Each varies only for 3 months. That's why futures are for 3 months. That's why denominator is fixed for 3 months. No question, no doubt about it. Memorize it. Numerator part can vary. That can be more than 3 months. Don't think because it is 3, the numerator has to be 1 or 2 only. No, it can be more than 3. Can be for 12 months, but it has to be in months only. If they say in year, convert that year into months. If they say 2 years, 2 years will be in how many months? 24 months. Understood? This is based on your loan or deposit, whatever it is, in months. For how long is your loan? Is it for 6 months? Are you taking that loan? Is it for 7 months? Question will tell you. Okay, so that divide by 3 months. That amount of the loan divide by the future contract months. That is 3 months. Understood? So remember this fraction. Then you will get the number of contract needed. And for interest rate, it is, I think mostly it is, you will get an answer, whole answer. Now, remember, same like there, here also, future are not perfect. You might have imperfect. Why? Basis risk. And the other one is due to rounding the whole number of contract. If you are getting the contract in terms of decimal 98.2, you might take 98 contracts, right? So that 0.2 you have to hedge using something else. Perfectly you didn't hedge entirely this amount, right? So one is due to rounding of whole number of contracts, the other one is basis risk. Understand only these two things. Why? Theory. For theory question, they will ask you this. Why future hedges are imperfect? Why they are not so viable? Why you would not suggest? That time you can give these two reasons. Why? One is because it is basis risk. The other one, because you have to round to whole number of contract. Because of these two reasons, future hedges are imperfect. I'm assuming if question comes like this, it will be around 5 to 6 marks. So explain 5 marks, I would say 4 to 5 marks. So explain these 2 points. That's enough. Because wherever theory can come, I have included that also. Obviously, you will never get an AFM question without theory. Not all numbers. Okay. I wish it was all numbers. I know how much students crave for number. That's why people take finance. But sadly, that's not how it works. So you have to practice on your theory part, right? Coming to example. Because examples are the best way to understand. Okay. How do you know you have understood future? How do you know you have understood options? How do you know you have understood swap? Do you read and memorize? No. No way. You do a question. First time you will do a question, you will struggle. You will always want to look the answer. No. Don't do that. Allow yourself to make the mistake, because if you don't make the mistake, you will not know where you went wrong. You might end up correct also. Do it second time. Another question. If not the same question, do another questions of similar nature. There are so many questions. Trust me. Do the third time, do fourth time, do fifth time, and see yourself how you're improving. You'll be able to do it faster, you'll be able to do it more accurate, you'll be able to understand the question in the first glance. That's the best way to do. Number questions, numerical questions I'm talking about. You have to practice. That's how you understand that you have understood future. Once you're able to tackle most of the things, see here, listen to me, you will go wrong here or there. One or two mistakes you will get. Maybe your final answer might be wrong. That does not matter. That doesn't matter so much. Maybe you will just lose 1 mark, but focus on your workings. Make sure it's labeled. Make sure you are following through all the workings. Make sure you're not cutting down, not taking shortcut. Never take shortcut. Don't cut out on anything, any step. Every step needs to be shown in Excel. Okay. So make sure, because for those workings you are getting marks. Majority of the marks of a calculations, if you see you 10-20 marks, you think they will give you 10-20 marks only for one answer? No. For those workings. Even if your final answer is wrong, it's okay. Let it be. At least your workings are there to support you. Okay? And make sure most of it are correct. You will get wrong. No matter however much you prepared and studied that, you will get wrong. You'll be very shocked to know it. You might be blaming yourself, panicking, how did I make it wrong? That means I didn't understand future. No. If you are able to follow through all the workings on your own, and you checked with the answer, somewhere maybe calculation mistake, your calculator mistake, the way you input the data was wrong, and your final answer turned out to be wrong, that does not mean you are weak. That does not mean you didn't understand. No. You will make mistake one or two, but you understood. It's just that you need to be more careful. It's just that you are a human, you're imperfect. You cannot be perfect all the time. Some areas, yes, you might get all correct if you're very lucky. But don't push yourself to be that perfect person. Assuming you can never make a mistake. If you never make a mistake, that's only when you are correct. No. It's your working. The way you're showing the working, not your final answer, that matters so much. because final answer is just 1 mark, whereas you are getting 10-20 marks only for the workings. Okay, now, so with example, first we are going to go through the fall in interest rate, then rise in interest rate. So hedge for fall in interest rate. Assume it is now March. Okay, this company called XYZ, they are going for a, they have recognized some short-term cash budget. Okay, they are assuming they are going to have a surplus in 2 months time of 10 million. Okay, in 2 months for a period of 3 months. This is how they will write. In 2 months for a period of 3 months. This is how they write in interest rate. So interest rate in the next 2 months may fall. Why? Why are they concerned about fall? Because this is about investment. This is not borrowing. Please understand, whenever, whether you're taking a loan or whether you're investing, whether you're depositing, if it's a deposit, your concern has to be fall in the interest rate. If it's a loan, your concern has to be in the rise of the interest rate. It's not always that rising interest rate is bad. No, 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 no. Depends whether it's a deposit or a borrowing. Okay, now you want to hedge. Okay, so this is the answer. You are going for a 3-month future. June 3-month future. Why? March, right? April, May, June. Assuming March. Now March means end of the March. So we are not calculating March. April, May, June. The nearest future to that March is June. We all know 4 futures are there. March, June, September, December. Which one? March is over. Only June is there. So June 3-month interest rate future are available. Contract size also they have given you. 500,000. Price is also given. Check how the price is given, 96. That means what is the interest rate? 100 minus 96, 4%. Now you are required to hedge. What if the interest rate falls to 3%? If interest rate falls to 3%, your price will go to 97. Price will go up, no? Just check 100 minus 3 is 97. So now this is the solution. What was the amount of interest that you are going to receive on which amount? 10 million. For how many months? 3 months. At what? 3%. Because it fell down to 3%. Whatever the amount fell down or went up, at that amount only you pay. Okay, then you deal with the balance. So first check. Okay, at 3%, that means interest rate fell down to 3. At 3%, how much it will be? 10 million for 3 months at 3% is 75,000. Okay, just give me a minute. Yep. So just take 3 months of 10 million. That means 3 divided by 12 into 10 million into 3%. That will give you 75,000. Same do it with 4%. At 4% it will be 100,000. So can you understand what is that loss? You are losing 25,000. If it was 4%, you were gaining 100,000. Now because interest rate fell down to 3%, you are only getting 75,000. Difference is the loss. Step 1. Okay. That is the solution. But in your exam, things are not so easy. You have to go through the steps to get the marks. Step 1. What is this? It's a deposit. Because it's a deposit, you want to hedge against a rise or a fall? Against a fall in interest rate. Understand this. Number 1. Number 2. So this is how you do it. You have to understand. This is the future, right? You have to see. You want to hedge against a fall in interest rate. Whenever you have to hedge against a fall in interest rate, it's buy. You buy the future. You buy the future. And when you have to hedge against a rise in interest rate, you sell. It's fixed for interest rate. For currency, it depends based on which currency the contract is in. But here, things are easier. It's fixed. You can memorize it also. Better if you can memorize it, but with understanding. Why? If it's a fall in interest rate that you have to hedge. In short, if you have to hedge a deposit, you buy future. If you have to hedge a loan, you always sell future. That's it. End of the story. Because this is deposit, you buy. Always buy deposit and sell future. Sorry, sell loan. Buy deposit, sell loan. Buy deposit, sell loan for future. Okay. So get the number of the contract. 20 contracts. How? 10 million divided by contract size, which is 500,000. It was given in the previous slide. So 20. At which price? 96, because it is at 4%. Then step 2. Interest rate fell down. You sell at that price. You opened. Now you sell. Sell at what? Same 20 contracts but at 97, because interest rate fell to 3%. So there's a loss. Calculate profit or a loss on the future position. That is step 3. So you buy future at 96, you sell at 97, losses of 1. Sorry, it's a gain. If you check in terms of price, it's a gain. Don't check in terms of interest rate. Because if you check in terms of interest rate, you might be saying you're buying at 4%, you're selling at 3%. How is it a gain? Check in terms of price. Always. Then it will be easier for you. So you buy at 96, you sell at 97, higher price. It's a gain per contract, which is 1. Total gain. Now you have to find total gain. So 1 into, it's 1. No need to multiply, okay? Otherwise, maybe you can just multiply, but they didn't show it here because it's just 1. If it was 2 or 3, they might have shown. That you multiply gain per contract into contract. That is 20 contracts into tick size, 12.5. All this tick size and all they will give you in the exam. Don't worry. You just have to multiply it to find the total profit or loss. So into 12.5 into 100 ticks. Depending on how many ticks. Okay, sorry. This gain per contract is 1, right? That 1 you have to take it in terms of ticks. That gain 1.00 is taken there. Taken in terms of ticks. 1 gain is 100 ticks. Just simply multiply by 100. That's it. 100 ticks. Because you have to take it in terms of ticks only. So 12.5 into 100 ticks into 20 contracts. 25,000 is the profit. In the spot rate, it's a loss if you see 25,000. In the spot, you're losing, but in the future, you're gaining. That's how future works. I've told you in the exchange rate also. In the spot, if you're making a loss, in the future, you have to make a profit. Are you understanding? So fall in the interest rate means in the spot you're losing, yes, but in the future you are gaining it. So it cuts off each other. Now, in an exam, you may not be told what the closing future price is. Isn't it same like exchange rate? Yes. In this case, what should you do? Just estimate basis reduced to 0 in a linear fashion. Okay, this is the same. This you know about exchange rate also. You can use this in the exam to save your time, which is known as lock-in rate. What is lock-in rate? This is how you find the rate. 100 minus whatever the current future price given to you plus unexpired basis. In whatever thing, you have to calculate that unexpired basis. Without that, you will not be able to get that lock-in rate. So unexpired basis, make sure you know it. I'm not going to show it here. It's already shown in the previous, that is day 10. This rate is known as lock-in rate. Now we are moving on to interest rate option. This video is going to be a little longer. Usually all my revision videos are around 30 to 35 minutes. If you can say, this is almost 33 minutes, going to be 34 minutes. So this is going to take a bit longer. That's because I'm going slow, number 1. Number 2 is the last in risk management. So I want to take my own time before everything is clear, before you jump to that risk management question. This is the last revision also for risk management. Even though you might be thinking this is interest rate, why don't I just talk about interest rate and finish it off? No, I have to refer this to exchange rate because students may confuse the two. They often confuse these two things together. Now you can say it as an interest rate guarantee or an option on an FRA. Name does not matter. What matters is you know how option works. You pay a premium, get the advantage. What advantage? If interest rate goes in your favor, you can take the advantage. If it goes against you, hedge. Exercise the option and hedge it. So because of this flexibility, it's expensive. That means that premium, you have to pay a huge premium. Same like exchange rate also. Okay, and this usually happens. Interest rate options are more valuable when you don't know at which direction interest rate is going, whether it's going up or down. If you're sure interest rate is going to go up, You know whether you have to exercise the option or not, right? But if you don't know which way it's going, it could be favorable, it could be unfavorable. Option is the best in that situation. Then we have what is known as interest rate cap. What is interest rate cap? There are two things you have to understand. One is interest rate cap, the other one is interest rate floor. And together this makes a collar. Cap and a floor makes a collar. Understand? Cap is like your ceiling. See up, you have your wall, right? That's your limit that you can reach. Beyond that, can you go up? No. Ceiling is your highest max. So it is known as cap also, or you can say ceiling also. Floor, that's the minimum that you can go down. That's the lowest. Maximum, or you can say minimum. Yes, minimum. Your interest rate cap is the max, and your interest rate floor. Check your floor. That's the minimum. Okay. Interest rate cap is for the borrower. Interest rate floor is for the lender. Why? Because lender does not want the interest rate to go beyond the floor. There's a level. They fix at that rate that this is the floor. Beyond this, interest rate cannot go. If it goes, it's a sign of worry for the one who has to deposit. And for the borrower is the other way around. Their concern will be if interest rate goes above the interest rate cap. They do not want it to go above the cap because cap is the maximum. Understanding? So interest rate cap is used by the borrower, floor is for the depositor. Now, so interest rate option is basically, you can say, an interest rate option on interest rate future is an option to buy or sell future. Okay, do not get confused with these two things. Just keep option and future separate. That's what I would say. Coming to interest rate collar. What is collar? What is a collar? Just now I have told you it's a combination of cap and a floor. It includes both cap and a floor, right? Collar is just draw a collar. How it looks like, it's a V shape, right? Comes down, again goes up, right? It's like a zigzag, you can say. Just draw the shape of the collar of your shirt and all. So collar works also like that. How? See, if you just take an interest rate cap, or if you just take an interest rate flow, what do you think about the expense? You have to pay premium, whatever. It is an option only. Don't think because it's a cap or a floor, option is out. No, interest rate cap is option only. But rather than just taking option, see, option is giving you advantage of two sides, right? You can take advantage as much as you want. There is no limit, no cap, no floor. But with cap and floor, there comes a limit beyond which you cannot go down and beyond which you cannot go up. You understanding? It's just the same only. It works like option only. Interest rate cap, if you take for the borrower, that means beyond this, interest rate will not go up. You are sure of that. You are fixing that limit. But if the interest rate falls down, you cannot take the advantage. And same for the floor. If interest rate goes below the floor, you cannot take that advantage. Sorry, if interest rate, yeah. So collar reduces, just if you take a cap or a floor, it will be more expensive than the collar. You understanding? So collar is a lower cost compared to just cap alone or just a floor alone. Because how collar works, you have to take a cap and a floor. You are selling one thing and you are buying one thing simultaneously. Together you are doing it. That's why collar prices are less. Because if you are buying option, you pay a premium. If you're selling option, you receive a premium. So you're buying premium and selling premium nets off against each other, premium falls down, right? That's why, because you're buying one thing, you're selling one thing. So that buying and selling nets off against each other, premium goes down. That's why interest rate collar, we take interest rate collar. How? Let me now explain you. If it's a cap, if it's like a cap, I'm reading the second bullet point. Like a cap, the second sentence, after the first sentence. Like a cap, a collar can be used to fix a maximum rate of interest on a long-term variable rate loan. Correct? However, unlike a cap, the collar holder is unable to benefit from the reduction in the rate of the interest below a certain level. Collar has a level. Collar has both up and down. Cap only sets a ceiling for up, minimum, maximum. There is no minimum. It can go down as much as it can. Floor also is the same thing. It's a limit. But when a collar comes, there is a cap also. There is a floor also. It has two things together. So that's why you are in between those two things. Can you now picturize, visualize? You are in between those two things. That's why you cannot go up also above a certain point. You cannot go down also below a certain point. You can only take advantage in that range, in that middle part between the cap and the floor. You understanding? That's why you cannot take that advantage, reduction of the interest rate below a certain level in the collar. But in cap, you can do that. So because you cannot take that advantage, premiums also less in collar. Makes sense, right? Higher the advantage, higher the benefit you can take, more the premium. That's why collars are more expensive than collar. Caps are more expensive than collar. Flows are more expensive than collar. Similarly, a collar can be used to like a floor also. Okay, like in the floor, you set a minimum level. Floor also does that, but because it sets a maximum yield also. That means beyond that yield, you cannot take advantage. For the depositor, this is a disadvantage. In short, collar sets the floor and sets the cap. It limits both the sides. Both the side, it is limiting. The upside also, downside also. But in cap, it is only one side. Floor, it is only one side. In floor, you can go up as much as you want. In floor, you below a certain level, you will not go down. Same way for cap, you can go down as much as possible. There is no limit to the downside for cap. For floor, you can go up as much as possible. But when collar comes, neither you can go up below a certain level, neither you can go down below a certain level. Hence, collars are less expensive than cap and floor alone. I hope you can now understand collar better. That's why it took so much of time to explain over and over again, the collar. I'm sorry, I think I should have included some diagrams also. But anyway, textbooks are there. You have the soft copy. I've given most of you the soft copies, and you can go through it. The diagrams are there, right? Now, example. I always told you with numbers only you will understand how much theory you have understood. Memorizing cap works like this, flow works like this, collar is in no, will not help you. Very bad strategy. So a collar, cap, obviously. See, think cap can never be less than floor. How can your ceiling be less than the floor? Obviously, right? So cap is at 8%, floor is 6.5%, assume. Okay, it's a collar. That means your fixed maximum rate for borrowing is 8%, minimum is 6.5%. Okay, and for the cost of the collar is what? The premium that you have to pay. That is how much premium you have to pay for the cap, how much premium you are going to receive from selling the floor. In collar, what are you doing? Understand this: buying cap, selling floor. I repeat, buying cap, selling floor, buying cap, selling floor. But this is only for borrowing. If it's a borrowing, for if you are depositing, situation changes. You buy floor, you sell cap. You buy floor, you sell cap. But most of the time I've seen the borrowing part comes because borrower is easier than depositing part. So if it's a borrower, again I repeat, buy cap, sell floor, buy cap, sell floor. Same time you're doing, simultaneously you're doing it. That's why it's a collar, no? Because simultaneously you are doing it. And on this, there is an ACCA website, sorry, on your ACCA website, there is a technical article, how to answer an interest rate risk management question, that covers three things: forward, future, option. Please read it. Coming to interest rate swap. You can swap, you know swapping, right? You take my thing and you give your thing in return. My thing is yours, your thing is mine. And later we swap it again, right? Same way, interest rate swap, you agree, two parties agree to swap their floating rate of interest with the fixed rate of interest. Let's say you are currently buying, you are currently paying floating rate. Now you want to pay fixed rate. So you swap with someone who is going to give their fixed rate to you and you give your floating rate to them, right? We all know how swapping normally works. Now, let's go through it. What are the advantages? No calculations are involved in this revision series. Already interest rate swap, the how you have to do it, I've covered it in my lecture. If my lectures are not enough for you, you can go to the revision series, the whole AFM revision series. I mean, revision kit solutions are there. I have a separate playlist for it. You just have to go to my channel Sabi Akhtar and go through my playlist and search it AFM revision kit solutions. All I think one to, I don't remember how many questions. I think above 60 questions or 50 4 questions. I think all questions are there. It was done previously from the previous book, not this, not the latest, but still the way you solve the questions are same, because AFM syllabus did not change since then, since when I started doing the questions. So still you can refer that playlist for your revision kit solution. There I have done questions on interest rate swap. Please go and check those videos. Okay. Now, theory part. Let's come to the theory part. If they ask interest rate swap, uses of it. Number one, hedge against adverse movement in interest rate. Second, it's a way of cheaper finance. Third, okay, there is no third. Okay, who does this swap? Who arranges this swap? Normally the bank, right? And for this, they ask a price also. They quote a price, the ask rate. Okay, they quote the ask rate. So what is this rate? The rate at which bank is willing to receive a fixed interest cash flow in exchange for a LIBOR, or you can say a bid rate. Bid rate means it's a rate willing to pay for receiving a LIBOR. Okay, bank is receiving fixed interest and paying a LIBOR to you. Okay, and the difference between these two, the bank's profit margin is normally 2 basis point. Okay, this is I'm giving you to understand interest rate swap better. You don't have to write it in your answer. For further reading, again, FRA, that is forward rate agreement, and interest rate swap. Please go through interest rate swap. It's very important. Questions has been asked on interest rate swap most of the time. Many times I have seen. Okay. Now that's it. Yep. So we are here. Finally, we are on to our next topic of our AFM syllabus, that is accusation. So in the next day, that is day 12 and day 13, we will be covering accusation. And final day will be your reconstructions and reorganization. So see you in the next day 12. Until then, practice doing questions on your risk management, both currency and interest rate, and also on your previous this thing also, investment appraisal, and your section A of your AFM syllabus. That is the role of the senior financial advisor. Best of luck for your AFM exam and do lots of questions, and see you in the next video.